Welcome to today's breaking news. Here's a highlight of the day. Bank of Canada surprises what 100 BP rate hike to tame inflation. Ottawa, July. The Bank of Canada on Wednesday raised its main interest rate by 100 basis points in a bid to crush inflation, surprising markets and becoming the first G7 country to make such an aggressive hike in this economic cycle. The central bank raised its policy rate to 2.5% from 1.5%, the biggest rate increase in 24 years, and said more hikes would be needed. Economists and money markets have been expecting a 75 basis point hike. We had indicated we were prepared to be more forceful. Today was more forceful, Governor Tish Macklem told a news conference after a decision. Yes, it is a very unusual move to increase by 100 basis points at one decision, and that really reflects the very unusual, exceptional circumstances that we find ourselves in. Earlier, the central bank said excess demand, high inflation felt across sectors, and rising consumer expectations. The persistent price gains prompted the supersized hike, which lifted the policy rate to its highest level since 2008. If this doesn't get us back into the idea that the Bank of Canada is serious about bringing inflation down, I don't know what would, said John Murray, a markets analyst at Monex Canada. The Bank of Canada move follows a 75 basis point rate hike by the U.S. Federal Reserve last month. The Bank of Canada saw the Fed hike 75 bps and said hold my beer, said Royce Mendes, head of macro strategy at the Justin Group, noting hawkish language in the statement that accompanied the central bank surprise move lifted the Canadian dollar, which was trading up to 0.4% at the 12975 to the greenback by late afternoon. The benchmark Canadian stock index slipped to its lowest since March 2021. In its July forecast, also released on Wednesday, the Bank of Canada said it expected inflation to rise further, saying it would remain around 8% in the next few months. Canada inflation rate hiked 7.7% in May, nearly 40-year hike. The central bank now sees inflation averaging 7.2% in year, falling about 3% by the end of 2023, and then back to the 2% target by the end of 2024. The Bank of Canada has been playing catch-up with horse inflation for months, prompting rare attacks from price tick and fueling worries that Canadians could lose faith in its ability to contain prices, leading to price spirals. Our forecast is for a soft landing. As I said, the path to the soft landing has narrowed, said Mark Lamb, who participated in the decision remotely after recovering from COVID-19, and thus is an important reason why we took stronger action. Still, the 100 BP move couples with a warning of more hikes to come could spoke markets, said economists. I think the market is going to be on edge here about the possibility of more upside surprises on a rate hike, said Jeff Porter, chief economist at BMO Capital Market. The policy rate is now at the nominal neutral rate, the midpoint between 2 and 3%. The monetary policy is neither stimulative nor restrictive. The bank also cut its economic growth forecast for this year to 3.5% from a previous estimate of 4.2%. Its predicted growth would then slow to 1.8% in 2023 before rising to 2.4%. The slower growth is largely due to the impact of high inflation and tighter financial conditions on consumption and household spending, the bank said. Thank you for subscribing our channel. I'll see you in the next newsletter.